today I thought we'd start off with just a review of the markets and where we're seeing valuations at the moment. Out of that, we're going to highlight where we're seeing some risk prevalent in the market. Then we'll probably cover off on one of the more specific examples is the amount of work we do when we're looking at a new opportunity. And then thirdly, we'll just cover off on some of our top 5 investments we've made in the last 12 to 18 months. And just run through why we like these stocks and where we see the valuations. So the chart you see today is the dark blue lines there represents the price-earnings ratio of certain sectors. The dark blue line is the current price-earnings ratio. The light blue line is the 10-year average PE. You can see there's a highlight there of the healthcare infrastructure, information technology, utilities, REITs or property trusts, and infrastructure stocks in the industrial part of that chart there, that bar chart there. They're like the Transurbans, the Sydney airports, etc. There's been significant re-rating in those sectors. Why is that important? Because the reason they've re-rated mostly is these stocks are typically quite low volatility. Okay, they don't have a lot of amplitude in earnings, not as volatile as other parts of sectors like cyclicals. What's driven them mostly is the low rate world. We've all heard about low interest rates are here forever, etc. So that's natural. These people have gravitated to these sort of stocks that have either a dividend yield of 5%, etc. Most of these companies are paying out, outside of healthcare, 90% of their earnings or greater. Like with the REITs, it's 100% because they're a stapled security. So what that's driven is significant re-ratings of the multiple of these stocks. And while people say that rates are here to stay for a lot lower for a lot longer, I think current conditions are sort of suggesting that may not be the case. So while these are safe stocks, in the fact that their business models are quite stable, the price you're paying today, though, it suggests otherwise, that you're taking actually a lot of risk to get access to that income stream. So at this stage, when you look at how these stocks, or why these stocks are re-rated and why the market entirely is re-rated, because the entire market's actually on a high multiple versus its history, it's pretty much been driven by cost cutting, significant cost cutting, okay, low capex, so low capital expenditure. So companies are not investing in their business at the moment. It is easier just to cut people out of the business and run your costs a bit more leaner. So they are not investing in their business. Now that's fine in a low rate world, okay, but if you start getting rates going back up or credit spreads going back up, you can get caught out because you haven't been investing in your business. We'll go through an example of that later. But as it stands today, the market environment actually is changing, okay? The yield curve, the interest rate curve, is actually steepening and rates are going up. The market's setting rates. The conditions of the last several years of central bank accommodation are about to end, effectively. They've all talked about stopping accommodation with either cash rates going up or the enormous balance sheets a lot of the central banks are sitting on are going to be unwound. So they're going to be net sellers of securities. Some of the stats out there are that the Japanese central bank owns pretty much 100% of the bond market at the moment. They own every piece of paper. The ECB owns about 50% of all of European debt that's been issued by government. The US, the central bank of the Fed, has an $8 trillion balance sheet at the moment. So that's a lot of securities. And don't forget, they are price-insensitive buyers. They've been very price-insensitive for the last several years. So that means they'll be price-insensitive sellers. And us as the private sector, as investors, we want a return. So when they come to sell their securities, we're not going to accept current rates. We want a higher rate. Because the reason that they're unwinding their balance sheet is because inflation is starting to pick up. And we're going to be, as the private sector, we're going to be expecting a significant premium for that benefit. So what's going to happen is rates will be starting to step up. And these sort of stocks, the healthcare, it is called the HIP trade. We call the term the HIP trade. Healthcare, infrastructure, property, and it used to be pizza. But Domino's is derated by about 40% in the last 12 months. So that's been dropped out of that sector. So you can see with a Domino's example, when something goes wrong, it was on about 45 times PE, Domino's. When something goes wrong, the market's not kind. We're a quality and value investor. We look for quality companies, but at a reasonable price. And some of those stocks, in particular the healthcare sector in Australia is at about a 50% premium to global healthcare. So us Australians love paying up for things for some reason, including power prices. If you look at the next chart here, when you look at one of the reasons the markets, as I talked about before, the multiple has expanded, it's been mostly because of cost cutting and low capital expenditure. Companies are not investing in their business. Here's a chart of the industrials ex-financials margins, EBIT margins, and you can see that margins are starting to climb back up to pre-GFC levels. Okay, when you look on the right side of that chart, the right chart there, cyclicals, which typically become your resources and your industrial cyclicals like a building materials company, etc., they are now starting to reach their peaks also. Again, most of this has come from low capex and cost cutting. Okay. Now, the reason you have capex is it keeps you're more efficient because you're reinvesting back in your plant. And payout ratios, to make it a little bit worse, are very high. They're well above the average for the last 10 to 15 years. So companies are pretty much cutting their costs, not spending on their business, and then handing it to us as shareholders at well above what they normally should be doing. Now that's sort of setting itself up as companies that have been doing that, they're going to have a bit of a tough time if we actually have real inflation in costs. So what's happened in Australia in the last 12 months? For most businesses, energy prices are probably up about 40 to 50%. Okay, they have to take that cost on, and because they haven't been investing in their business for the last several years, there's no way they can find it. Where are they going to find the saving? They're going to have to pass it on, which puts you at risk from your customers, right? So we're setting it. This is quite an uplifting story, I know, but we're setting ourselves up for a bit of rotation in markets. We think there's going to be rotation out of the HIP trade, healthcare, infrastructure, very long duration businesses like toll roads, etc., more into businesses that we've been looking at that have been investing in their business for the last several years. They might pay a slightly lower dividend as a yield, okay, because they're only paying out between 50 and 70% of their earnings. So they're retaining some and investing back in their business. But that means they've been maintaining their cost efficiency, or they've been growing a new business, etc. They've been taking risk for just that time when things do change. And that's where we are today. Things are subtly changing in markets at this stage. If we have a look at the types of stocks that have benefited from low rates, it is this clutch of stocks you see there. They're considered low volatility stocks. They are low beta. Now that chart is beta, which is a measure of historic volatility of stocks returns through time. Those stocks typically, as I mentioned before, have low amplitudes. When markets go up a lot, they don't go up as much. When markets go down, they don't go down as much. So they're a bit more safer through the cycle. But what's happened is, in the thirst and hunt for yield and low rates, is people are willing to pay a lot more for that income stream out of these stocks. Okay. Now the perception is that these are actually defensive, but the price is actually suggesting otherwise. They're a lot less defensive. So that chart shows you now that those stocks are now got a beta. So how much riskier are they than the market? Closer to the market now. So you've actually got a lot more market risk if you own that sort of bunch of stocks than you ever have if you own them today. So they're a lot more risky than compared to history. And why that's important is, if you pull out an example there of, say, Telstra. Now, no one was expecting Telstra to cut their dividend by 30%. Okay, we didn't own any, and then as a house of Perpetual, the work we had done had shown that they'd been paying out 95% of their earnings, 95%, retaining 5% to invest in a business. Let's face it, there's a lot of engineering going on. So there's a lot of capital required for that business. So paying out 95% and under-investing in their business caused what to happen? Their mobile margins were 40%, EBITDA margins of 40%, highest in the world. And a bit what Woolies did about 5 years ago, where they allowed Aldi into the market by having very high margins. Telstra allowed TPG, which is probably one of the lowest cost operators in telcos, to go get mobile spectrum, to go build their own mobile network. So by under-investing in their business, Telstra's basically allowed the barbarians inside the gate. So now they're getting competed away by a much smaller, probably more nimble operator. And they had to cut the dividend material because now they have to do some catch-up CapEx. So CapEx to sales has gone from 12% up to about 16%, which guess what has been the average for the last 20 years, about 15 to 16%. So they're going to have a period of higher CapEx because they need to catch up. Okay. Now, because of that, they had to cut the dividend by 30%. So no one expected that to happen. Everyone thought it's a safe bet, but it happened anyway because the company really wasn't technically running their business for the future. They were running more, us as shareholders, we want our money back, right? We want our income, we want fully franked dividends, I get it, but sometimes the market can be wrong. You don't run your business for 2 to 3 years, you've got to run it for 5 to 7 to 10 years when you're talking about business strategy, particularly in a big, heavy industrial business like that. If you pull out Transurban, toll roads, they're great businesses, toll roads. What usually blows up toll roads is the capital structure you wrap around it. So when you've got a lot of debt, okay, there's a long history of toll roads in North America going broke, all the way back to 80 years, because they put too much debt in them. Because they're such secure cash flow, people get more and more, and as rates fall, they put more debt into it. So they're borrowing from the future to pay dividends today. Now, Transurban has a debt structure of 8 times net debt to EBITDA, okay? So 8 times the amount of debt compared to what they earn before bad things, which is costs. So it's not really their earnings, okay? So that is the sort of financial gearing that we saw in the GFC, okay, pre-GFC. Companies were doing 8 to 10 times net debt to EBITDA. Now, Perpetual, we focus on balance sheets quite a bit. The reason we focus on balance sheets is because it gives you optionality when things go wrong. Because good companies will protect their business by having reasonable gearing, low debt, and when the rain comes, they're prepared to take advantage of that opportunity, buy out a competitor, expand a business, move into a new market. So as it stands today, a lot of these low volatility stocks have significant volatility as it stands today. So be careful about that clutch of stocks. If you own some, look at the capital structure. If they've got not a lot of debt, you're probably okay. Are they investing in their business? Can they grow the dividend? Because if we're moving into a world of inflation, you need to be able to grow your dividend to beat it. That's our job as fund managers, is to beat inflation over time. We've had low inflation, it just get a sneaking suspicion it's starting to lift. The oil price is sort of starting to suggest that we're starting to get a bout of inflation coming. One other chart I wanted to highlight to everyone is this chart about ETFs. As an active manager, I'm going to defend our patch. ETFs are great, low-cost ways of getting access to market with index investing, ETFs, etc. They are very cheap ways of getting access to beta or market risk. Because they charge a very low management cost, 5 basis points, virtually nothing to get access to it. But passive only really invests on the basis of one thing, which is it in the index? Okay. Telstra, as an example, is in a yield ETF, global yield ETF. It was one of the biggest allocators of, it's one of the biggest positions in the yield ETF, global yield ETF. Do you think that the yield ETF expected Telstra to cut the dividend by 30%? No, they didn't. Right, because I don't think about, the ETF's not thinking about the balance sheet, not thinking about margins, they're not thinking about CapEx, not thinking about any of that. Now, I'm going to read you a couple of ETFs I picked up on the net that are today I find quite interesting. Tell me if you know what these are. The Inspire Global Hope ETF. You pay 60 basis points to get access to this. It is a biblically responsible ETF. The Horizon, this is self-explanatory, this one. The Horizon Marijuana Life Sciences ETF. You can buy these online if you want. I can tell you the ticker code for the Inspire is BLESS. Thank goodness. You can also buy the Obesity ETF. Its ticker code is SLIM. That is 80 basis points to get access to that ETF. Okay. And then you've got the good old Millennials ETF. And no one knows what price that is because they don't speak to us. So as you stand today, the only reason I bring that up is that chart, what it shows is that dotted black line is the number of indexes and ETFs today. The white dotted line is the number of listed stocks. So today there are actually more indexes than stocks they're meant to track. So we're at a point where there's a lot of esoteric style indexes. Like an S&P 500 ETF makes absolute sense because you're buying a broad, balanced portfolio. ASX 300 is the same, etc. But now you're getting these sort of ETFs, okay, being issued today. You're not taking market risk anymore. You're taking idiosyncratic risk, stock-specific risk, okay? What reasons, how do they build the index? These are the questions you've got to ask. How do they build the index? How does something get into that index, okay? These are very stock-specific, and typically liquidity is quite poor. So everyone remembers flash crash. That was basically a couple of ETFs unwinding. So people trying to get out. It drove GE for one trade down 80%. Okay, this is the market environment we're sort of living in at the moment. Yeah, it is people taking their market, and this is typical of a longer bull market, where you're at the ninth year of a bull market. Structured products usually tend to help democratise future losses. They tend to get people into the market, and these are these sort of these products. I might step on to, this is our quality filters. I do this every result and briefing. We've been using these quality filters for 50 years, doesn't change. They tend to keep us out of trouble, okay? So quality business, we look at the returns of the industry, returns of the business, how they generate it, how easy is it for capital to enter and exit an industry, the maintainable returns, etc. Conservative debt, we look at businesses, 50% net debt to equity, okay? A lot of business can run slightly higher than that, so we look at the interest coverage ratio, how much of their earnings can they cover their interest bill with. We won't invest in companies with 3 times or less EBIT interest cover. Sound management, we do over 1,000 meetings a year with management, unlisted companies, competitors, ex-employees, etc. That's the whites of the eyes test. That's all about understanding how management, understand how they behave in bad times, not good times. Everyone thinks they're a hero in a bull market, and when things are going great, you want to understand how they're going to protect our capital and what are they going to do when things get bad. Okay, that's what we're looking for, quality management. The last one is recurring earnings, which is all about we don't invest in concept stocks. Companies have to make money before we invest in them. Even as they're private companies, we want to see some profit when they're a private company as well, before they come to the market. Why we do that is it's a bit more conservative than most other styles, but when you have GFCs and big drawdowns in markets, these sort of characteristics tend to protect you, and you don't have large drawdowns, which is, rule number 1, don't lose money when you do investing. Okay. This is one of the stocks we've been buying for the last few months. It's called Shire. It's a UK healthcare stock. It specialises in a thing called rare diseases. So these are diseases which are very small populations. And what typically happens is large pharma companies like Pfizer and Glaxo don't want to typically invest in them because they are small markets, like $200 million or 300, small populations, etc. So no one's been developing drugs for these patients. So the FDA a couple of years ago changed the approval profile for these rare diseases, and they call them orphan drugs. Okay, and what they do is, if you're a drug company that develops for these, they'll accelerate the approval profile as long as it's safe, and there is some benefit to the patient, and so it shortens the approval profile. And what Shire does is it invests quite a bit in that. They've got quite a large portfolio of very small drugs, which is great because there's not a lot of competitors in those sort of markets. Now you can see on the right there the Shire in the yellow versus CSL in the blue. Now Shire owns a bioplasma business, which is exactly the carbon copy of CSL. Shire's trading on about 9.5 times PE. CSL's currently trading on about 33 times. Again, us Aussies love to pay up for things. What are the differences in the business? Why have we decided to make an investment here? The opportunity arose because one of the drugs that Shire is actually quite dominant in is in haemophilia drugs, okay, bleeding disease, and They've got about $2.5 billion of revenue in that part of the business. Now, there's a competitor called Roche that developed a drug called ACE910. Now, to be a bit technical about it, most haemophiliacs are treated via intravenously through a vein. Roche has developed a drug which you can do subcutaneously, so you can just jab it under the skin. Okay. Now, the market's been worried about this for the last 9 to 12 months. That's why you can see the share price has been derating all the way through. But what we've done some work to show that the market is expecting that haemophilia franchise to halve within 3 years. Now, we've been putting all our work to understand why a clinician would convert someone from current treatments to the new treatment, ACE910. Now, what do we like about the business is it's a technical business, but we actually understand the markets that they're in. They've got strong market share. In bioplasma, they are the equivalent of CSL. CSL will say otherwise. We believe they have a better portfolio of IVIG than CSL. They're growing their sales. They've got 60 drug candidates in the clinic at the moment, with about 17 of them in phase 3, phase 2B, phase 3, so ready to be commercialised. They generate about $1 billion of free cash flow a quarter. So they're on about a 12% free cash flow yield. So they are paying off debt quickly. And we quite like the board and the chairman, very sound management. The CEO's been rationalising the business and optimising the assets. So this issue with this new drug has created an opportunity for us, an opportunity to assess the risk of what the market's suggesting is a third of the business or 25% of the business will halve. So I raised one of the, you can see there the major concerns, the haemophilia franchise. Everyone expects it to halve over the next 2 to 3 years. The immunology business, which is bioplasma, people don't think it's worth a lot. They did buy this business 18 months ago, and the market's pretty much halved the value of it in that period. They've got a drug called Lialda, which is being attacked by generics. That's definitely going to happen, so the market's accepted that. And the markets have got concerned around the business divesting of a neuroscience business. So these are all big things. Sorry, the haemophilia is the biggest thing that the market's concerned about. The others are more, we think they're priced in, that's probably fair. So what did we do? We've been conducting surveys of haemophilia clinics in US, UK and Germany, about 57 clinics that treat about 200 to 350 patients. So a good 10 to 15,000 patients, basically. That's who they treat. Trying to understand why a clinician would convert someone from the current treatment to a new treatment. Okay? We wanted to understand, we spoke to some infusion clinic specialists. So when you go to be treated, you go into an infusion clinic and they put the IV in and they apply the medicine. Try and understand the economics. Who wins, who loses out of the economics changing here. And then we've spoken to HAE experts and specialists, which is another drug they've got coming to market, IVIG clinicians, just get a better understanding as to the perception of Shire in the market. Not our market, not financial markets, the real market, the real world, with patients. So what did we find out? So we found out that there's two types of patients in haemophilia. There's a patient with inhibitors, right? So they can't actually use a lot of treatment. They've developed resistance to certain type of treatments. And they only have really two choices when they've developed these inhibitors, which is a drug owned by Shire called Faber, which is 40 years old, and another drug by Novo Nordisk called Novo 7, but that's it, okay? Our view is that market will disappear pretty quickly because the standard of care in that market is quite low. It's a low bar to jump over. ACE910 is better than everything on that to treat those patients. So that's our assumption that goes. But the clinician's saying 25% of them will switch inhibitor patients over 5 years. Now remember, the market thinks half the business is going to disappear in 3 years. Okay. More importantly though, non-inhibitor, which is 2/3 of the market, there's a very high standard of care. There are 8 products which reduce bleeding events by 90%. Okay. There are products which are 20 years old that patients are happy to stay on. They will not shift. The reason that is if you look at the history of haemophilia, if you go back to the 90s, there's an entire generation that was infected with HIV. Okay? They don't trust anyone. So they're very conservative about what they do, and the clinicians are even more so. The most important factor we found out, though, was over 60% of the physicians want 5 years of safety data. So after it's been used by other people, they want 5 years of that data to be collected first before they even consider switching their patients over. So what that's telling us, there's a lot of inertia in converting patients. There's a lot of trust of current brands, okay? So there's a lot of incumbency. So the market's pretty much gone straight away and said, right, discount it by 50%. Our view is it might take 7 to 10 years to convert. So that's raised an opportunity for us. Oops, sorry. So the conclusion, it's trading well below their global peers. You know, CSL's on 33 times. Most of the drug companies they compete with are on 18 to 20 times. Shire's on 9.5 times PE. Market's overestimating the erosion. They misunderstand Baxalta, which is the IVIG business they bought. And we're going to get EPS growth of between 7 and 10% and deleveraging pretty quickly. So a lot of book value growth. So now we'll just turn over to quickly go through the stocks we own today. These are pretty major positions in the pick. And remember I talked about we're looking for companies that have an opportunity to invest in their business and have been doing so over the last several years because they're the ones that are going to be able to grow the dividends over the next 5 years. Star is one of them, the the entertainment group, let's call it the casino group. Now, they've got an ability to invest in their current assets, so the Star in Sydney. They've just upgraded the old Jupiters, it's now called the Star Gold Coast, bring it up to at least 2,000 levels of accommodation. No, they've actually taken up to 5-star levels. And they won the tender to build a new 6-star resort-style facility in Brisbane. So the old Treasury Casino is going to close, and this is going to be a new facility. Now, typically with a casino, you don't buy them when they announce enormous amounts of capex, because they are pretty big paperweights until they start earning some money. A lot of construction up front, a lot of cost, risk of blowout, etc. But what they've done is they've partnered up with 2 Hong Kong companies that won the bid together with Star, which is Far East Consortium and Chow Tai Fook out of Hong Kong. I think Far East Consortium owns pretty much most of the parking stations in Melbourne. So they've been in Australia for 25 odd years, these companies. And what they're doing is Star is going to be able to use their balance sheet to finance it. So the returns, the incremental returns on this capital is materially higher than what traditionally would occur. So with Star, we can actually see, we can actually map out the growth of the dividend profile because they can actually invest and grow their earnings because they've got opportunity to invest. Woolworths was one of the first companies we invested in 3 years ago. I think it's pretty obvious now the turnaround has occurred. They've got their mojo back, Woolworths. They're beating everyone else into submission. Now, everyone's very worried about Amazon. Our view is in grocery, the last mile infrastructure is the most important part. Okay, that is how close are you to the customer? Physical distance, right? So Woolworths has 960 stores. We're doing work as we speak today to work out how far they are from the majority of the population, whether it's 2 kilometres or 5 kilometres. They've got 1,300 BWSs in Australia. They've got quite a few Dan Murphys. And if the BP Woolworths deal occurs, which is now in front of the ACCC, they'll pick up another 600 to 700 to 800 new sites where they can do online fulfilment, click and collect, etc. So they're getting very close to the customer. Now, this wouldn't work at all unless they improve the offer. And I think what we've seen in the last 12 months is that the customers have responded to the $1 billion of investment the companies put into to the offer, both the staffing, product quality, on-shelf availability. Now they're at a point where they're now starting to do click and collect, online ordering, online delivery, etc. So we're of the view that Woolworths actually is best placed to take on an Amazon. Okay, we thought it was quite instructive that Amazon went and bought a bricks and mortar retailer in North America. Okay, I think it's going to be a bit harder to go from an online shopping business into an omni-channel. They call it omni-channel, bricks and mortar and online, because they're about to discover what fixed operating leverage is when you have a lot of leases. Okay? Woolworths has to deal with that every day. I think it's a bit easy for Woolworths, given they are 40% of the retail market in Australia, in grocery, to go into online. The other thing we like about it is there's $1.80 of franking credits on the balance sheet. As the manager of the PIC, I'm trying to get those franking credits into the PIC. So we're trying to encourage them to pay out a nice big fully franked dividend to us. The third one there is Oil Search. We actually do have quite a bit of oil exposure in the PIC today. We do own Woodside as well. And we've got a company called Incitec Pivot, which is a derivative of the oil trade as well. So oil or energy has underperformed for basically 2 years. It's been lagging for quite a bit. We like the business. It's a high-quality asset. It's got a good balance sheet. They're probably the lowest cost LNG producer in the world, probably cheaper than the Qataris. And they've actually got a field ready they can develop, which will probably double production. And the reason we're encouraged by that is because if ever anyone's noticed, the oil price has sneakily gone up to above $60 again. So it's up about 20% in the last several weeks. And funnily enough, it all correlated when the Australian government announced they might reserve gas for Australians. Because the Asian LNG price was about $6 per TCF, just a measurement of the amount of energy, and Australia was at about $8. Domestic prices were higher than international prices, Southeast Asian prices. The minute the government announced that, the price went up to $8.50 in Asia, which tells me that the market is very short energy. Okay, there's not a lot of, there's been no development of a major oil discovery for 10 years. Okay, the world needs about 90 million barrels a day of oil. Okay, the decline rates of conventional fields is about 4.5 million barrels. There's about 80 million new cars a year, including electric. And those 80 million cars need about 1.9 million barrels a day just to travel. So we're actually looking at a potential squeeze in energy markets. It does help having Saudi Aramco trying to list next year as well. They want a high oil price. So we quite like Oil Search because it is high quality, good balance sheet, and they can actually expand production in a tight oil market or energy market. Thirdly there is AXA. It's a boring old life, non-life business. But we quite like it. It's on a price to book of about 1, where most insurers are trading on 1.5. Extremely well run. The dividend yield we're getting out of a European stock is about 4.7%. Not fully franked, I get it, but they've got the discipline to pay it. It's only paying out half of its earnings. So it's got a buffer if things get a bit tough to grow the dividend or pay it, at least pay what they're currently paying. And the management's very rational. They're trading at book value. They see that as an opportunity. They see that the market doesn't understand the value, so they're going to spin off their US life assets, and they own a fund manager in the US called AllianceBernstein. They're going to list it. And the way fund managers are trading at the moment on about 15 times or 18 times, they're trading on 10 times. They've announced they'll probably buy back stock. It's hugely accretive if they do that. So the EPS growth will go from 5% to 7 to 10%. Also, cyclically, they are very sensitive to interest rates. So as rates go up, they make a lot of money. Okay? They told us basically that if rates stay where they are today, they'll do 3 to 5% EPS growth. If rates in Europe go up 50 basis points, in the US 100, you can expect that number to get to 10 to 15% pretty easily, all else being equal, without a bit of competition. So it's quite a bit of cyclical leverage as well. We like it just for the structural leverage at the moment. So as it stands today, or as of this report, we're 59% invested in Australian securities, 24% in global. We're right up against our limit. We're seeing opportunity out there. We've got about 17% cash. That has been used a bit in the last couple of weeks. We have been buying, as I said, we're buying a lot of energy exposure. So about performance, I'll just be brief on the performance. Just more about where we got it from. Nancy mentioned about 480 basis points of the performance came from our global positions. This is the alpha, 4.8% above market. About 250 basis points came from our domestic portfolio. Cash was a drag of about 220 basis points, having too much cash. And the currency, with the Aussie dollar rallying, costs us about 110. And I'll hand back to Nancy. Thank you.